Cryptocurrency price trends and trend line. Now, all cryptocurrency price movement are determined by the volume of supply and demand at any point in time. Price tend to move in a direction, and these said directions are what we refer to as trends. When you hear about trend, what is trending now? It means what is actually on board now. Price move in trends because of an imbalance between buyers and sellers. When something is popular, is because majority of people likes that thing than others, right? So there's a majority carry the vote kind of scenario going on. This is the same thing when you hear price moving in a trend. It means that whichever trend is in play has the majority on its side. So if we have more supply in the market, more sellers in the market, then we're going to have the direction being on the downtrend. And if we have more buyers, that is more demand in the market, then we're going to see price heading to the uptrend. When the supply of a cryptocurrency is greater than the demand of that cryptocurrency, the trend will be down, as there are more sellers than the buyers can handle. Likewise, when demand exceeds supply, the trend will be up, as buyers bid up the price, leading to price rising higher to seek sellers to withstand the increased buyers. But when the forces of supply and demand are equal, what then will happen? Or when they are nearly equal, like let's say one is 50%, the other one is 50%, or one is 48%, the other one is 52%, very near equal, the price will tend to be stagnant. The effect of that volume on price will be very unnoticeable, moving to and fro some particular price range as a result of the equilibrium between buyers and sellers. This phenomenon is what is known as trading range. Trading range, in other words, occur as a result of buyers and sellers being almost equal in terms of numbers or volume. Eventually, new information will enter the market. So we have what is known as either a breakout, so there is equilibrium between buyers and sellers. Now this equilibrium is definitely a struggle, as more buyers come in with their money, they are almost instantly followed by the same amount of sellers. I bring $2,000 to the table, someone is there to take the $2,000. At the end of the day, nothing is changed. So because of this period is a period of anxiety. A lot of emotional pain occurred during the trading range. Eventually, new informations over the time we enter the market. During this period of trading range, at some point, the equilibrium will be altered. As more buyers keep coming in and they don't get enough sellers, it means the buyers will overwhelm the sellers and price will be forced to bid higher and go higher to seek more balance for more equilibrium. Just know this, at every point in time, price is trying to seek balance for itself. But you know price cannot be balanced at all the time, because at some point more people want to buy, at some point more people will want to sell. But price is always seeking for a balance. So whenever price sees balance or opportunity of being in a balance, we see price pause for a while. But that balance is instantly, like often followed by a disturbance of one party overwhelming the other. Always remember that cryptocurrency futures gives you the opportunity, unlimitless opportunity, to profit in both uptrend market and downtrend market. By what? By either buying long or selling short. Now you ask me, what is buying long, what is selling short? If you're new to trading, selling short simply means selling borrowed coins which you hope to buy back later at lower price. You either go short, be short, or you stay short. Now when you buy, it is said that you are going long, or you're staying long, or you are long until you sell out. Now this is opportunity that is being provided by exchanges, depending on the exchange you're trading on. So back to our topic, a trend to the upside is known as uptrend, and a major trend is known as a bull trend. Remember, we said a trend means majority, right? Majority people. So if the majority people are on the buyer side and we have more buyers outweighing the sellers, then we will have an uptrend. A major trend is known as a bull market, while a trend to the downside is called a downtrend, and a major downtrend is known as a bear market. So you will want to stay bullish in an uptrend, focusing on only buying coins, and bearish in a downtrend. That means you focus on selling or shorting the market. The key to success in trend analysis or trend trading is to determine when the pattern or trend will change, so that you can shift your position direction on time for bearish to bullish or from bullish to bearish. Timing is important. It's the only way you will be able not to be taken unaware. Uptrend. This occurs as price swings and make higher highs and peaks. When it pulls back or it retraces, it makes a higher low. It doesn't go below the last valley on a given coin, and this can last for a minimum of several weeks to maximum of years. So downtrend, on the other side, this occurs when prices start making series of swings of lower peaks and lower bottoms. Instead of when it rallies, it makes a lower peaks, and when it drops, it makes a lower bottom, like the valley goes below the last valley on a given cryptocurrency, and this can last for several weeks to years as well. Now we have different types of trend. We have three very important different types of trend. Trends which last for months are known as primary trends, or you can call them major trends. Now, trends that last for few weeks, are called secondary or intermediate trends. Now we have the last aspect of a trend, which is trends which are very short-lived and brief. They occur on a day-to-day daily basis, and these are known as minor trend. These are what the scalper trade. A scalper trade the minor trends, right? And a swing trader, most of them trade the intermediate and the major trend. So let's further break down this trend to get a better understanding. So I'm going to start with primary or major trend. Now, this broad movement, because it's actually a broad movement, usually lasts for more than a year or might even run for several years, resulting in general appreciation or depreciation in value of the coin in more than 30%. Let me give you an instance. Bitcoin. When Bitcoin broke from 12k and started its journey in 2020, and by 2021 Bitcoin was able to hit 60k. This is a good example of a primary trend. You can see it lasted up to a year. That's a good example of a primary trend. The simple characteristic to know when a primary trend is up is that each successive rally reaches a new high level than the last one before it, and each primary reaction stops at a higher level than the previous reaction. They will be printing what is known as higher highs and higher lows. Conversely, the characteristics of a primary downtrend, on the other hand, begins when each intermediate decline carries price to a successively lower level or lower bottom than the previous, and each intervening rally fails to succeed the top of the previous rally by forming what is known as lower high. This is how the primary trend is known. Secondary or intermediary trend. In the cryptocurrency market, the secondary or intermediate trend, these are the reactions or pullbacks occurring in a bull market, and rallies and uptrend occurring in a bear market. Remember what we say a bull market is? We say a bull market is the major trend. That's the primary trend. And we say what? A bear market is also the major trend and a primary trend, right? So the secondary trend acts as a pullback or a pull-up in the primary trend. The secondary trend exists inside the primary trend. Normally, they tend to last from few weeks to a few months. They always tend to retrace about 2/3 of the previous profit or loss made by the preceding swing in the primary trend. You see, we have time frames. A lot of people ask me, what time frame should I trade? This is a very good example of how time frame play a major role. You see, the primary trend or the major trends are found on the higher time frame, like the monthly chart, the weekly chart. These are the time frame that any big move that is occurring on that time frame is a significant trend. Now, if we look at the daily chart, the 4 hours chart will give us example of what an intermediary trend might look like. Here we can use time frame to even help us understand how the trend works. Let's look at the minor trends. This is the third aspect of the trend. The secondary or the intermediate trends are said to be made up of smaller trends that occur on the intraday basis. Fluctuations in the market that occurs during the day are what is known as minor trend. They usually last about 6 days or even 3 weeks. So we're talking about the 4 hours chart, the 1 hour chart, lower time frame. It's giving us minor trends, and anything from 4 hours all the way to a weekly chart is giving us the intermediary trend, and anything from the weekly chart to the yearly chart is giving us the major trend. So I think that's how I use these to characterize the market. So now let's talk about bull market. Let's break down bull market and understand what a bull market is. The primary bull trend usually consists of 3 phases. The first phase is known as accumulation, and this occurs when the market conditions are still poor and the general public is discouraged with the cryptocurrency market. Prices tend to trade in sort of trading range during this time for months. The second phase is known as advancing stage. At this stage, prices are now fairly steadily advancing, and at this point they tend to increase in demand and activities are beginning to pick up in the market, and the general public are beginning to pick back interest in the crypto market, and news is beginning to look good. The third phase is characterized by the cryptocurrency market rising to a spectacular price gain, followed by a massive publicity filled with good news, social media, Twitter, everywhere. The press is all about Bitcoin, it's all about crypto, everywhere is money now. That is the third phase. This leads to a sudden growth in the public interest and involvement in the crypto market, which leads us to what is known bear market. Let's understand bear market, because if that is the 3 phases, then what happens after the 3 phases? The primary trend of a bear market also consists of 3 phases, and these 3 phases are: the first phase is known as a distribution phase. This is when the foresighted crypto investors sell their coins to less informed public. This is where you hear people say people are buying the top. The second phase is in a bear market is known as the panic phase. Here, buying tends to decrease and dry up slowly while selling becomes more urgent. This leads to prices forcing a downtrend as the price accelerates and starts moving as there's a mounting volume due to panic selling by the general public. Everybody is selling, everybody wants to run. It's the same thing that happened when Bitcoin broke the support of 48k. We saw that spiral down to 30k on a down move. That is a panic selling. The third phase is called secondary recovering phase. Here, the price enters a very long period of sideways movement. That's a complete trading range for a long period of time. The public news begins to deteriorate and prices resume their decline, but less rapidly than before. Finally, the bear market is said to end when everything that has to do with crypto and bad news has probably and possibly been discounted and more interest start coming back into the market. So we have yet going back to accumulation. So a cycle between buyers and sellers. This brings us to how can we tell when each phase is entering the next phase? How can you tell when price is moving from one phase to another in terms of price life cycle? How can I know when distribution phase is ending and we're entering a panic stage? Now this brings us to what is known as trend lines. Now, because trend lines will help you better determine the trend that is in force and when the trend is about to end. If we are to pick a ruler or a line on your chart too and use it to connect any 2 lows or any 2 valleys on a given cryptocurrency price chart, the line you just drew connecting the 2 lows or the 2 valleys are what is known as trend lines. If a market is moving up, you draw a line connecting each successful higher valleys or bottom. As long as the market stays above that line that you've drew, the uptrend is enforced. And conversely, you can do the same in a downtrend. You will draw a line connecting each successful lower peaks. Or conversely, in a downtrend, you will draw a line connecting each successful hills, or should I say tops or peaks, that rallies. As long as price remains below that line, the downtrend is still in force. We have the horizontal line. This is not different aspect. Anything can be used. Knowing the difference is very important. A significant trend line. We have trend lines and we also have significant or important trend lines among all the trend lines. So if you draw so many trend lines on your chart, there are only few that are more important to you than every other one on that chart. Knowing the difference is very important, as a significant trend line will be touched at least 3 times or more before it breaks. These are the lines that you should be your major signals for a buy or sell. These lines will set off your sirens once they get violated, because the break of a significant trend line can change the trend direction and reverse it to the opposite direction. A break below an advancing trend line is a bearish sign and a negative signal to exit a buy position trade, while a break above a declining trend line is a sign of a bullish market and you should exit the short. It is important to remember that in an uptrend, when using a trend line, that the greater the slope of a given trend line is, the less meaningful the break will be. It will not be important, meaning that if you end up with a advancing trend line, a break below it might merely mean that a coin is just probably on a pullback, or maybe just a slowdown in the movement, and soon the move will continue. It may merely be that a coin is now going up at a slower rate of advance as it was prior to the advance, as its prior rate of advance was not sustainable enough to sustain it. A break below it may merely mean that the coin is now going to up. Likewise, in a downtrend, the steeper the angle of the descent of the declining trend line you draw connecting the hills or the peaks of the rallies that occur in the downtrend, the less likely bullish it will turn out to be when it overcomes the trend line. All it may mean is that coin is just probably going to decline at a slower rate than it was declining before, right? It does not mean that once it crosses above that line, it will all of a sudden become bullish, because remember, your trend line is steep. However, when advancing trend line in an uptrend is horizontal or even closer to being horizontal, the breakdown of that trend line is said to be more bearish. So there is a strong support on that. Right here, what I'm trying to say is that horizontal supports are stronger. Either is horizontal, or is close to being horizontal, or is near horizontal. At least let it not be too steep. Conversely, a break of a declining horizontal or a closer to horizontal trend line on a downtrend is said to be very bullish. So if I have a horizontal trend line on a down market and they make it above it, is a good bullish sign, because before they can make it above that horizontal line, they would have hit it more than minimum of 3 to 4 times. That's to tell you how strong horizontal trend lines are, right? So it mustn't be completely horizontal. It can be near horizontal, but at least it's not steep. That's very important when considering the trend line. Trendline theories. Trendline theory states that once a trend line is penetrated and successfully price closes below it, the trend which was previously in force will likely be reversed. Therefore, if an uptrend trend line is penetrated and price successfully closes below it, it is a signal to sell. And if a downtrend trend line is penetrated and price successfully closes above it, it is a signal to buy. But then, what about a situation when a downtrend trend line has just been deceptively broken to the upside? Should you now believe that the trend has changed, or there is an uptrend that has started? A trend line, I would say, must meet a minimum of 2 touches to be trusted before taking a buy decision. You should not draw a trend line yet until prices move higher for about a week and then react and dip downward as a retest, and later starts moving higher again. Now you have like valleys to connect, right, easily to give you an uptrend trend line. But if you don't wait, the price just broke out. You don't know how far down it's going to react. You don't know where to connect your price. Even though you connect with the trend line on a lower time frame, the trend line will tend to be steep and cannot really be trusted. This is why it's good to be patient, that after a period of accumulation and there is a breakout, you should wait for the pullback to occur first, give you a valley or a low to connect in order to form your uptrend line. This will give you a higher bottom to which you can now connect the first bottom to form an uptrend line you can trust. If the prices after moving higher react and then dip downward and form a third higher bottom on the trend line, the trend line then becomes even more valid. You can take a trade. We then say that the trend line has been successfully tested and held, and the longer the trend line holds, the stronger the trend line becomes. After 4 touches to 5th, it's likely to become weaker, like I said earlier, and easily susceptible to breaking down. In summary, I would say here are the factors that you should consider when trying to weigh the validity of a trend line, if it's a strong trend line or a weak trend line. One is the number of lows or bottom it has been able to connect, the number of valleys you're able to connect with that trend line, or the number of highs or tops or peaks or hills it has connected or formed near the trend line. The overall duration of the trend line is the second criteria that can help you know if a trend line can be trusted. Overall duration, how long has price been able to stay above it? The steepness, I talk about the steepness because it's very important. Is it horizontal? Is it near horizontal? Or is it more horizontal? Or is it even just straight, almost a straight line? But what if the market advances and then dip to form a third bottom and low, but this time it forms way above our trend line? Now, where can we say is the real trend? What if the market advances after our third valley or bottom it has made on the trend line, on the uptrend trend line, and then there's a sharp move upward, and this time around it formed a valley way up above where we can connect? There is no longer connection, far from our trend line. What should we do in such scenario? Well, we may have to wait until the 4th low bottom is formed, or the 4th valley. You know, we've already had 3 touches on the trend line, and now price has rallied so up and formed another valley that we cannot connect with our valley. It will be a good idea to draw another trend line in the form of A and B. Here we're going to have multiple trend lines giving us what is known as the fan line. So what is a fan lines? Now, a fan lines is a form of a multiple trend lines. Here they are formed when market reacts and dips sharply, creating a steep trend line, but oftentimes these trend lines will get broken by sharp rallies that at which point will require a trend line to be drawn again. This second trend line is also known by this second trend line that you draw is also broken by yet another trend line. So fan line comes in the form of a multiple trend line, and this is how it looks like. Here it is formed as market reacts and dips sharply, creating a downtrend trend line. But oftentimes that trend line that just dip, that is sharp and steep, they will get easily broken by little rallies. Any sharp rally will break the trend line. So now where is our next resistance? We need to draw yet another trend line. This is where we bring in another trend line from A to B. The second trend line is also broken easily by yet another rally, leading us to draw yet another third trend line. Such line is what is known as fan lines. Fan lines come in the form of multiple trend lines. Here they are formed when market reacts and dip sharply, creating a steep trend line, downtrend trend line. But oftentimes the downtrend trend line will get broken by a sharp rally that can cause that trend line to be valueless to us and force us to draw yet another trend line to connect the new hill or the new peak that the rally has made. This second trend line is also broken by a rally and another third trend line will need to be drawn. Such lines are known as fine lines, and fine lines can help us know when the trend has changed, as the fine line rules implies that when the third line you draw gets broken, it means that the trend has changed. This rule can be applied in reverse to uptrend as well. It can be applied in the uptrend as well. So we can have fine lines on downtrend, and we can still have fine lines on uptrend. So now let's talk about pullbacks and retests. Retests, also known as pullbacks or throwbacks, is a phenomenon that often occur after the breaking of a trend line. Interestingly, I must say, for an uptrend advancing trend line, prices, once the advancing trend line is broken, the decline is likely going to continue lower for a few days. It will then rally back again to the broken trend line, then breaks above it, and prices will continue the decline. Pullback and retest. Retest, also known as pullback or throwback, is a phenomenon that often occurs after the breaking of a trend line. Conversely, the reverse will be the case when we talk about downtrend, decline, broken. The reverse is the case when we talk about downtrend. So here we see price breaks from a downtrend trend line, moves off, advance for some time, and then return back to that same broken trend line, sit on it, and then before advancing and changing the direction all the way to the upside. This can be a perfect way to take profit or exit any trade. I normally recommend selling half of your coin position on an advancing broken trend line, right? When an advancing trend line breaks, an other half you can sell it on the retest of that breakdown if the breakdown is confirmed. How do you know or know a valid breakdown or a valid penetration? How do you know which breakdown or breakout is what calling valid? Because there are things called false breakout. But how to differentiate a valid trend line penetration from a stop loss hunt or a false penetration? You see, normally a penetration of a trend line or an advancing trend line in this case is clear signals to sell and exit a buy position, and a penetration of the declining trend line, that is the down line, is also a clear signals to buy. But oftentimes it is not always simple, as we see in practical charts that sometimes prices do return after one or two candles, only to continue the move in the previous direction before the penetration. This is known as false penetration. So we see price breaks the support, goes below it, you would think it's going to close. In fact, some do close below it, but the next candle that comes up instantly pushes the price back above the trend line. This, you will even think that in such uptrend trend line, that if you are such a person that is not patient, you will fall trap and victim of such. And this is why it's not good to place your stop loss exactly on the trend line. You give it a little, like $1 or so gap, to able to give you that chance of reacting to any sudden reaction, right? So give a little gap. It mustn't be a lot. It depends on your entry price, so you know how to, but don't put your stop loss exactly on a trend line. Chances are high you'll be kicked out and the move will continue in the same direction that you entered the trade, right? This is what is known as false penetration. Here are a few questions to ask yourself when you see a trend line break occurs to easily help you to validate if you can trust that penetration of the trend line or if it is just a stop loss hunt. So one of those is, when the penetration occurs, was the body of the candle that penetrated that candlestick small or big? If it turns out that the penetration candle is small, like in form of a doji or a spinning top or a hammer or inverted hammer, if so, it remains that there is over 75% chances that you are having a false breakdown or breakout on your hands. It means that that is a suspect, and we must look at more factors to determine for more clarification, right? So the second thing we will look at now is, did the price close below the trend line? That is, the candle that broke the trend line, did it close below the trend line, or did it break the trend line only for the price to pull back above it and close above the price, above the trend line, leaving you with just the wick or tail penetrating through the line, while the body is above the line? If it's below the line, that is uptrend. If it's above the line, that is downtrend. For a valid advancing trend line penetration, the candlesticks that penetrated that trend line must close below the trend line, and conversely, for a valid downtrend trend line to be called breakout, the same is the case. The candlestick that penetrated that down declining trend line must close above it successfully. The third thing you're going to ask yourself is, did the volume pick up on the day of the penetration? If so, there's a good chance that the penetration is valid, because volume is a strong indicator of price assurance. So if on the day of breakout to the upside, the break of the downtrend trend line, there is high increased volume, chances are the breakout is real. Now, on the aspect of the downtrend, volume can play magic here, and volume can be very tricky because prices can fall on their own weight, which means prices do not need necessarily strong volumes to break down and be a real breakdown. I keep saying that in all the videos when I talk about volume, that in a bear market, you must not judge a bear market volume the same way you judge a bull market volume, right? Because in a bear market volume, you need strong volume from buyers to overcome the sell-off, and price will change direction. But in a bull market, you don't necessarily need the strong sell-off for it to occur, because as a result of panic selling, just a little push and everybody will start panicking. That is the secret. Was the break of the trend line accompanied by a reversal pattern candlesticks? If so, then you will give there is more credibility that the trend has changed direction. Another question is, did the penetration occur after several days of trading range or sideways price movement? If so, this is likely a test of the trend line than a true breakout. Penetration is happening in a range market, then it could be a test of that trend line, and it could likely not be a true breakout. It can likely be a false. So we recommend you wait for more price movement to conclude that what you saw is a real breakout or a real breakdown.
I always fought just to wear the crown. I'm pissed off at these fucking clowns who were all taught they deserve an ounce. It's only worth